Have you ever looked at a stock and wondered, is this company really expensive or is it a bargain? Most people check the price per share, but that's like judging a book by its cover.
Hey, real quick, before we jump into the video, please take some time to read the full disclaimer on the screen.
Today, we're going to talk about two super important terms that can tell you a lot more about a company than just its stock price: market cap and enterprise value. By the end of this video, you'll know the difference, why both matter, and how to use them to make smarter investing decisions. Stick around because there's a part at the end where I reveal a simple trick that professional investors use to spot bargains. Let's start with the easier one: market cap. Market cap, short for market capitalization, is basically the total value of a company's shares in the stock market. The formula is really simple. Market cap equals share price, X number of shares outstanding. So if a company has 10 million shares and each share is worth $50, the market cap would be 10 million times $50, which is $500 million. That's it. Super simple, right? But here's a question for you. If two companies both have a market cap of $1 billion, does that mean they are exactly the same in terms of value? Think about it for a second and drop your answer in the comments below. I'd love to see what you think. Here's the thing about market cap. It tells you the value that the stock market assigns to the company's equity. But, and this is a big but, it doesn't tell you the whole picture. Market cap ignores how much debt a company has, how much cash it holds, or other financial obligations. And that's where enterprise value comes in. Enterprise value, or EV, is often called the true cost to buy a company. Think of it like this. If you wanted to buy the entire company, not just its stock, but everything, how much would it really cost you? The formula for EV is a bit more detailed. EV equals market cap plus total debt, cash and cash equivalents. Let's break that down. Imagine a company with a market cap of $500 million. It also has $100 million in debt, but $50 million in cash. The enterprise value would be $500 million plus $100 million, $50 million equals $550 million. Why subtract cash? Because when you buy a company, the cash on its balance sheet can offset some of the cost. You could use that cash to pay down part of the debt. And why add debt? Because if you're buying the company, you're also taking responsibility for paying off its debts. Makes sense, right? Now, let's make this more interesting with a real-life analogy. Imagine buying a house. The market cap is like the listing price of the house. But if the house comes with an outstanding mortgage of $50,000 and a safe with $10,000 inside, the true price you'd pay is different from the listing price. Enterprise value is like the total price you're effectively paying for the house after considering debts and assets. Here's a question for you. If a company has a small market cap but a huge amount of debt, does that make it cheap or expensive? Think about it and drop your thoughts in the comments. I'm curious to see how you reason through this. Now, why does this matter for investors? Market cap is great for a quick comparison between companies. For example, tech giants like Apple and Microsoft have huge market caps, trillions of dollars. Smaller companies might be in the millions or low billions. Market cap is often used to classify companies into large cap, mid cap, and small cap categories. But here's the catch. Market cap doesn't tell you how much it would cost to actually buy the company. Enterprise value gives you that full picture. EV is widely used in financial ratios, especially when comparing companies with different amounts of debt. One common ratio is EV/EBITDA, which helps investors understand if a company is overvalued or undervalued. Think of EV as a more honest measure because it accounts for both the equity and debt side of the business. Let's do a quick example to make it concrete. Company A has a market cap of $1 billion, no debt, and $100 million cash. Company B also has a market cap of $1 billion, but $500 million in debt and only $50 million in cash. Which company is more expensive if you wanted to buy it? For Company A, EV equals 1B plus 0, 100M equals $900 million. For company B, EV equals 1B plus 500M. 50M equal $1.45 billion. Even though both companies have the same market cap, company B is much more expensive to buy because of its debt. That's why enterprise value is crucial for a true apples-to-apples comparison. Here's another thing. Some investors fall into the trap of looking only at market cap. They might see a stock with a low market cap and think, wow, this is cheap. But if that company is drowning in debt, it could actually be a risky investment. On the other hand, a company with a higher market cap but manageable debt might be a safer, smarter pick. Now I want to ask you something. When you look at a company, which do you think is more important? Market cap or enterprise value? Or do you think both are equally important? Drop your answer in the comments below. I read every single comment, and I'd love to hear your reasoning. Here's a cool tip many beginners don't know. When comparing companies in the same industry, EV is usually the better metric because it standardizes the comparison. Two companies might have wildly different debt levels, but EV puts them on the same playing field. Also, let's not forget cash. A company loaded with cash might have a high market cap, but actually be undervalued when you consider its enterprise value. Conversely, a company with a small market cap and huge debt could look cheap on paper, but be a financial nightmare in reality. So, how can you remember the difference in a simple way? Think of market cap as what the market says the equity is worth, and enterprise value as what it really costs to buy the company. One tells you how the stock market values the company's shares, and the other tells you the true economic value of the business. Here's another thought-provoking question. Would you rather invest in a company with a lower market cap but high debt, or a higher market cap with low debt? Why? Take a moment and leave your answer in the comments. I want to see how your thought process works. Before we continue, if you're finding this video helpful, make sure to like this video, subscribe, and share it with friends who want to learn about investing. It really helps me bring more amazing content like this to you. Now let's talk about one last tricky point. Why EV can sometimes be higher than market cap and sometimes lower. If a company has more debt than cash, EV will be higher than market cap. If it has more cash than debt, EV can actually be lower than market cap. It's not magic, it's just math. And understanding this difference can prevent you from making big mistakes as an investor. Here's a scenario for you. Company X has a market cap of $2 billion, $1 billion in debt, and $500 million in cash. Company Y has a market cap of $1.5 billion, $200 million in debt, and $100 million in cash. Which company is more expensive to buy if you were acquiring them? Take a second to calculate it in your head and comment your answer below. Don't worry if you're unsure, we're learning together. Finally, let's summarize everything in simple terms. Market cap equals share price. X shares outstanding. It tells you the value of equity according to the stock market. Enterprise value equals market cap plus debt, cash. It tells you the total cost to buy the company. Market cap is easy and quick, but can be misleading. EV is more comprehensive and gives the real picture. Always consider EV when comparing companies in the same industry, or when debt levels differ significantly. Understanding both of these metrics is a game changer for beginners. It separates casual investors from those who make more informed decisions. If you remember just one thing, market cap is what people pay for the stock. Enterprise value is what you'd pay to buy the company outright. Now here's my final question for you. If you could only use one metric to evaluate a company, which would you pick? Market cap or enterprise value? And why? Type your answer in the comments. I really want to see what you choose and how you think about it. Thank you so much for watching till the end. If this video gave you clarity, hit like, subscribe, and share it with your friends. I post content like this regularly to help you become a smarter investor and make sense of the stock market without all the confusing jargon. Remember, investing isn't about following the crowd. It's about understanding the numbers, asking the right questions, and making informed decisions. So go out there, check some companies, calculate their EV and market cap, and see if you can spot opportunities that others might miss. You now have the tools to look beyond the stock price and truly understand what a company is worth. That knowledge is powerful. Don't just invest blindly, invest with insight.